Good evening, and welcome to another episode of the weekly webinar. Today, we're going to talk a little bit about Trump 2.0 and its implication and opportunities. Now, let's get started. First, with a disclaimer, this presentation is not an offer to buy or sell any kind of securities and should not be construed as investment advice. And the opinion expressed within this presentation are mine and mine alone, and it's got nothing to do with the sponsor. So be aware that there is an element of risk when you trade margin products. And I'm going to start by saying that the year has actually started on a rather rocky manner. We have seen Wall Street actually hit record highs in December. But when the year 2025 started, we see that the market has been struggling. In fact, it has actually come off, except for this Friday, market having a rebound towards the end of the week trading. But by and large, we are beginning to see what looks like the start of a correction. There is no risk of a crash this year, but I think the market is really overvalued, and a little bit of correction is actually overdue. So for now, until at least March, I think there is that situation in which there's a very high likelihood that the correction that we're beginning to see over the last 2 weeks may actually continue. It may actually accelerate, but it is not a crash scenario, okay? And we have also seen that we are only 28 hours away from Trump inauguration, which will actually start on our time, Singapore time, at 1 a.m. On Tuesday morning. Okay, of course, that will be 12 hours ahead of United States. And we are beginning to see what it's going to be like once he gets back into the White House. Market are beginning to react, and I'm afraid when the market reopens on the next trading day, tomorrow will be a market holiday. The US will be celebrating the Martin Luther King Jr. birthday. Of course, we also knew that there will be the inauguration day, so the market will be closed tomorrow. But once the market reopen on Tuesday, there will be a little bit of a rough start, I would say. Okay, so far this year, we can see that the major US equity index has been coming off. They have not been able to register new high, and this is a sign that we are probably at the very beginning of a corrective that pattern that may actually last all the way to March of this year. So here we are. The market has already shown a sign that there is that hesitation to take market ever higher, largely due to the expectation that the Federal Reserve may not have more interest rate cuts in 2025. Now, remember at one stage when the Federal Reserve started to cut interest rates in September 18, 2024, market talked so that there will be 4 interest rate cuts in 2025. And by the time the third cut came in December, market has actually tempered their expectation of further rate hikes by the Federal Reserve from 4 to 2. And now there are certain banks already forecasting there will be no interest rate cut this year. The Bank of Japan, the Bank of America actually came out with a report on Friday and said that they don't expect interest rate cut in 2025. So we can see the expectation has been dialed back quite dramatically. Okay, so of course this week as well we have seen the release of the producer price index and the consumer price index. Both has actually been less than expected, which actually caused the market to now revive back expectation of further rate cuts. So there is a little bit of a contradiction. The market has not decided whether there will be more rate cuts or there will be less rate cuts or there will be no rate cuts this year. But by and large, we can see that inflation, though has eased off a little bit from November to December of 2024, is on an upward trajectory. So I think going forward it's safe to expect they will be seeing elevated prices for the whole of 2025, generally speaking. Okay. Then of course we have the Dow Jones. Okay, we can see the Dow Jones itself as of last month, the high traded in the Dow Jones was at 45,073. So that was the high. And based on the 2022 September low, we have seen that the Dow Jones has actually appreciated by almost 57%. And when we compare to the pandemic low at 18,213, we can see that the Dow has generally had more than double to 147%. So we can see that this market is generally very, very bullish. What we are seeing down here is basically a pullback, and it's actually quite normal for the market to pull back. Now, remember, going into 2021, we can see that there was a bit of a pullback, but eventually the market struggled all the way lower, established a low in September of 2022, and then started to rally. You can see this rally has almost doubled, okay? Has gone up by 57%. So this is something that we may be looking at. Further pullback may actually be a buying opportunity. And going forward, I think at least for now, maybe they will present a buying opportunity somewhere in the second quarter of this year, okay? So this is the S&P 500. We can see the S&P 500 has been a lot more dramatic compared to the 57% rise in the Dow Jones. The S&P 500 during the same period, having established a low in September of 2022, has actually increased by 66%. And when we compare to the pandemic low, it has gone up by 165%. So that's 20% more than the Dow Jones in the same period that we are looking at. So again, we do not have a new high so far this month. The high was traded in the first week of December, just under 6,100. There's a lot of people saying that they expect this year we may be seeing 63,000 or 6,300 in the S&P 500. But then, of course, there is no timeline here as when that will be achieved. But by and large, I do largely concur with that analysis. But first, I think the market will be coming on under a bit of a profit taking. Eventually, the market will be likely to see new highs going into the later half of this year. Okay. So this is the Nasdaq Composite. You can see Nasdaq Composite has been even more dramatic. We can see that the market has almost doubled from the December 2022 low, almost 100%. Okay, so that it means that it has actually has doubled. But compared to the pandemic low, it is up to 100%, 2x from the pandemic low. So the bulk of the attention that we have seen so far in 2023, 2020, and 2024 has been all things in the tech sector. Okay, so of course the latest run up in the later half of 2024 has been all centered on AI stocks, and that has still been very much the play. Okay, so we have seen the Dow Jones itself is what we call Johnny come lately. It actually was underperforming for a good part of last year until the last few weeks of 2024, in which the market actually play a lot of bit of catch up, and the high trader is just above 20,000 in the Nasdaq Composite. Okay, so what about the regional markets here? We can see that from the peak to where we are as of last week, we can see that most of the market has been seeing negative growth. The worst is actually in the Hang Seng, is down almost 18%. This is followed by the Nikkei 225 down by almost 9%. And then, of course, you can see the table over here. This has been all showing lately. There is a bit of weakness in equity markets around the globe. Okay, so far based on the performance we have seen on Friday, we have seen the DAX actually went up to new all-time high. The same is also applicable to the CAC, to the Euro stocks. So we can see that the reason why we are seeing European stock at all-time high is basically a currency play. We can see that both the Euro, the Sterling has all been trading negatively against the US dollars. So when you look into the currency perspective, it does appear to be cheap relative to the US equity markets. So that is one of the reasons why we see European stocks have been trading into all-time high despite the rather negative outlook in their economy. Okay, so here we have Treasury yields. Treasury yields has been the biggest talk so far for the last couple of months. We can see that You can see the red line here represents the 1-month bill. Okay, what we are referring to the US Treasury bills, and these are the yield. So you can see that for a good part, we can see that the yield has been trading above the longer term rates. The blue and the green lines represents the 30 years and the 10 years respectively. Okay, especially the green line. The green line is a 10 years yield. So when we compare the 10 years and a 1-month bill, okay, we can see that the yield has actually inverted in a in the in a correct in the normal market. We can see that the long-term yield should be higher than the short-term yield, and that is considered normal. When it starts to revert, when the short-term yields become carries a higher yield compared to the longer term treasuries, it means the market has inverted. Okay, for a long time, the market has inverted until recently, where this relationship has gone back to normal. This is called an uninversion over here, okay, where the longer term rates now goes back to normal during this period of time. You can see the longer term rates are basically having higher yield compared to the short-term yield. Okay, so this uninverting of the treasury yield is where markets are focusing on, because throughout history, when the market inverts and then uninvert, like what we are seeing right now, always leads to a recession. So talks of a recession is still very much in play this year. Okay, it's a question here. Let me see what's the issue here. Tanvi is asking, the US Treasury yields are for newly issued treasuries. You can see that in the treasury market, beside the primary market where only the dealers are able to deal in the wholesale market, there is a very vibrant, we call it second-hand market. Okay, just like when you buy cars, there's a very vibrant second-hand market for used car, for example. Okay, so in the treasury market, they also have the same thing. There's a secondary market where people buy and sell US treasuries very, very actively. So this is referring to the secondary markets, okay? But of course, it will also have impact on the primary market. For example, Janet Yellen has been warning for months now that the US debt ceiling has already hit its limit. I remember a report that she's mentioned something like January 14, in which the US will again hit the national debt ceiling, and in which unless Congress approve new limits, the US Treasury will not be able to borrow anymore by selling treasuries. Okay, so we are at the moment in time whereby this uninversion in the US Treasury yields is going to have a material impact on how much the US Treasury can sell. Now we can see that the shorter term yield has has gone back to normal. That means the incentive for people to go into the money market to buy, let's say 30 days bills is lesser now, okay, because now the longer term treasuries carries higher yield. Okay, so this will have material impact on the money market. In terms, it will carries less pressure for the US Treasury to borrow in the in the shorter end of the curve. Okay, so now the Treasury will have to issue more bonds in the 10 years and 30 years. Okay, the demand is coming back up again. Okay. So this is the breakdown of the this area here that I've shown you. You can see the uninversion is actually here in mid-December. Since mid-December, we can see that the longer term yield represented by the green and blue line, which represents 10 and 30-year bonds, is relatively higher compared to the 30 days treasury bills. Okay, so this uninversion is something that we have to watch, because it has always never failed to bring about a recession. So a recession is likely to see this year, but I think the one that we have to worry is still in Europe. Although the DAX and the Euro stocks has been trading into new all-time high, that has been a result because the Euro as a whole has been coming down rather aggressively against the dollar. And this is basically, when you view it from the US fund manager perspective, European stocks seems to be a steal compared to, let's say, American equity markets, okay, price in US dollars. So that has been the play. So I think the danger here is to look out for what's going to happen from Europe. We have a situation not only in the currency falling relative to the dollar, we also have a sovereign debt issue that may be something that we will have to focus on very much in Europe. On top of that, we also have to look at Japan. Japan is going to be considering hiking interest rates this week itself. If that's the case, I think they will actually bring about more demand for, there will be an unwinding of the yen carry trade. So again, we have to watch all these signs, not just focus on the US markets exclusively, because the danger is going to come from outside of the United States. Okay. So the other piece of news that came in this past week has been a report that says that US bankruptcy is at a 14-year high. Beyond this, here, of course, we're talking about corporate failure. Okay, if corporate failure is at a 14-year high, that means to say that this report came in before the December number came in. So you can see the December number, which is the orange bar here, is missing. Okay, but this is up to November for the past 11 months, ending in November 2024, and we can see that US corporate failure has been on the rise, and this is not a good sign, because if the US economy is strong and robust as the GDP suggests, then why are we seeing record corporate failures? So obviously, this is a statistic we will have to consider when we balance the optimism shown by the GDP numbers. Soon we will be avail ourselves to the Q4 2024 GDP estimates, and so far for the whole of 2024, it has been outperforming most of the G7 economies. So right now, among the G7 economies, US economy on paper, based on the GDP data, is suggesting that the US is on very, very firm footing. Okay, but when we contrast that to reports such as this, then we have to wonder whether those numbers is actually telling the full story or not. Okay, because not only are US bankruptcy at 14 years high, we can see credit card delinquency is also at a 14-year high, meaning to say that at the corporate levels, companies are not doing that fantastically, and at the individual US consumer levels, more people are behind in their payments of minimum payment for credit cards, and this is also at a 14-year high. So when we look at the corporates, we look at the individual levels, the US economy may not necessarily have staying power going forward. Okay, so this is something that we will also want to keep in mind when we look at the other data set that comes in week after week. Okay, so again, IMF MD, okay, has been warning that Trump's threat to impose tariff is actually a negative for the global economic growth story. So because when Trump threatens to impose universal tariff on all its trading partner, whether it is Canada, whether it's Mexico, whether it's China, it goes beyond that. Companies that export to US or use that have very high exposure to the US as an export market will all be hit regardless of where they produce their products. Okay, if so long as they sell into the United States, Trump's universal tariff is going to be a negative, and that could actually bring about a global winter in terms of economics. Okay, because when you have a tariff, it becomes more expensive to export into the United States. And again, Trump has been telling the whole world that US consumer will not be burdened with the extra tariff. But we have seen during Trump 1.0, most of the tariff has been borne by the importer, which is US companies, which eventually will be passed on to US consumers. So Trump's idea of imposing tariff to actually stimulate companies to relocate their manufacturing base into the States may actually backfire. Trump is a very simple man. He thinks that if he make it very expensive to sell into the United States, he logically wants them to move their operation and manufacturing base all the way to the United States, so that they can bypass the tariff for imported goods. So I think his thinking is that if he make it painful enough, companies that used to sell to America may decided that it would be cheaper to set up shops in America. But there's a lot of manufacturing that cannot come back to America because America simply do not have the necessary criteria to actually support certain manufacturing. For example, let's say footwear, which the US wants to encourage the manufacturing of Nike shoe back in America, because America had decided that they want to go up the value chain, and all this low end of the value chain is something that they have deliberately tried to we call it offshore. Okay, so now if you want to reshore all this manufacturing, it means they must be very selective of what they want to reshore. If they want to reshore the high tech, for example, semiconductors, for example, US face a bottleneck because they have not been producing enough STEM students to actually be able to man the factories for high tech products. TSMC has already set up shops and are beginning to produce the 2 nanometers micro chips in Arizona. But what happens is that they couldn't find qualified engineers to man the production line. TSMC has to import Taiwanese engineer wholesale to Arizona to get the production line going. So this is a bottleneck. As much as they want to reshore, they do not have the talent, okay, because for too long they have been neglecting the manufacturing. So on the low end, I don't think it will make sense for America to produce shoes or garments, for example. On the high end, they do not have the necessary talent to actually be able to encourage manufacturing. So by and large, whichever sector the US trying to reshore will end up to be very uncompetitive. And of course, the net result will be whatever they produce will be very expensive. It will not be competitive. Okay, so when we look at the Trump's tariff policy, it is overall a negative. It's a negative for America. It will be a negative for the entire world. Okay, so by and large, I think the world will start to reorganize their production line. Maybe they will basically bypass America as an export market and basically trade among themselves. Yes, US is a major markets for a lot of nations and companies. But if the tariff is going to be defining factor to consider, I think it will make sense for a lot of people to skirt around the American market and basically forego the American markets. And if that actually happens, and that will be disastrous for the US economy, because consumer will be not only having to pay higher price, they will not be able to get the goods and products that they normally would need. Okay, so imagine if China produced a lot of products for America and suddenly China decided that they do not want to sell to America anymore, then obviously US consumer will be negatively impacted. So all this will have implication. Okay, so again, the net we will have to see as the months goes by. Like I said, we are only 28 hours from Trump's inauguration, and Trump has actually announced that he's going to start mass deportation beginning the day after his inauguration, okay, on Tuesday. And he will start with Chicago. He has already earmarked the immigration and customs department to actually start to round up illegal immigrants. And there's a lot of news that say that people who felt that they are under threat to be deported, they have already started to voluntarily leave America. So this over time is going to impact a lot of industry, especially industries that depend a lot on migrant workers. For example, in the cultivation, agricultural sector, in the hospitality sector, for example, because these are the jobs that America do not want to do. Okay, Americans do not want to hold these jobs. So a lot of companies has to be depending on illegal immigrants, paying them below the what call it, below the standard wages, okay, to save costs. And if suddenly there is a vacuum in terms of difficulty to find these what I call illegal immigrants to take these jobs, eventually the cost will have to go up. So net, we can see the mass deportation movement, for one, is going to be very, very expensive for US to carry it out. US has never have a mass deportation in the numbers that we are talking. Okay, so that will be negatively impacting not only the immigration, not only the certain industry like agriculture and hospitality. It will also have a negative impact on the bottom line because illegal immigrants actually pay taxes. Okay, so if you take away these immigrants, workers, suddenly there will be less tax collection, there will be less contribution to the economy. So by and large, it will be a negative in my opinion. So here we have the producer price index. Again, the core producer price index is an index that consider inflation at a wholesale level minus food and energy. That's why it's called core. And it came in lower than expected. The previous number in November was 3.4%. You can see it's the highest throughout the whole of 2024. And they were expecting this number to get from bad to worse to 3.8%. It did not come out as bad. In fact, it was actually marginally better than November number at 3.3%. So the market right now is actually very happy with this number. It suggests that, okay, the fever that we have seen for the last 6 months has finally been tempered, has actually gone down a little bit. So now there's expectation that maybe the rate cut is back into play. So this was in the beginning of the week itself where the PPI numbers were released. So the market actually chilled this number because now going into this week itself, we knew that the market was basically quite pessimistic about further rate cuts. But with these PPI numbers, talks about more rate cuts is coming back into play. So this has been one of the reasons why we see a bit of a rebound in equity markets this past week. Okay. So the other one, of course, is this whole week has been all about inflation numbers. Over in UK, we can see that the CPI numbers on a month-over-month basis has actually worsened from 0.1% to 0.3%, as you can see in this chart over here. It has been going up and down. So compared to November, it has been worse off. So this has been a negative. And on a year-over-year basis, when you compare the headline numbers, which is the dark blue color, and the core CPI on a year-over-year basis, which is the light blue, we can see that both suggest in the core number, we have a bit of a pullback. Okay, core number was actually 2.6% in November, came in at 2.5, although the market was expecting 2.7. So it wasn't as bad, but the core was actually better. From 3.5, market was expecting 3.4. It came in even better at 3.2%. So this has been a positive, but again, it is too early to suggest that inflation is not going to be an issue in the UK markets going forward. This is the number that again caused the market to rally. We can see that the CPI numbers month over month, you can see the headline numbers went up from 0.3 to 0.4, a little bit more than the market expectation. And the core has actually come off from 0.3 to 0.2, as you can see in this chart over here. This is the month over month number. The 0.4 has been on the upper end of the range, but it has been elevated. But when you look at the core on a month-over-month basis, this is about the lowest we have seen since July of last year. Okay, so 0.2 is actually good. Now, when you look at the year-over-year number, again, we have acceleration on the core number. We have the headline year-over-year CPI numbers rising to 2.9% within expectation from November number of 2.7. Okay, here, when we look at the core has actually dipped. The market was expecting 3.3%, it came in 3.2%. So this is the number that people are looking at, the core CPI numbers year over year. It has shown that it has actually stopped going higher. It was at 3.3% for 3 months in a row from September all the way to November, and the December number came in marginally lower. So that was cheered by the market. And this is one of the reasons, together with the PPI, market expectation now is that maybe the Fed has reason to actually continue to cut rates. Market is expecting 2 rate cuts. Maybe they will get what they want. Okay. Now, in Germany, we are looking at the harmonized index of consumer prices. Now, this is another set of inflation number. This is the year-over-year number. We can see in Germany, it has stayed at 2.8%, and this has been the case. Okay, 2.8% is where the market is right now. It's very elevated. Retail sales is the other big number for this week itself. US retail sales has actually dipped on a month-over-month basis, but the core, not the core, the control group is actually better. Okay, almost doubled from 0.4% to 0.7%. But when you look at the headline numbers for retail sales, it actually dipped from 0.7 to 0.4. So this is a negative, but the control group is a positive. So they basically cancel each other out. So there is no sign that the US has stopped spending, at least not in the retail sales number here. Okay, but it has also shown that the US retail market, compared to the US consumer, has not been particularly spending a lot. Okay, it's very hard to spend more when you have a lot of what you call that, missed payment in credit cards payments, right? So this is right now becoming a drag on the US economy. I think the US consumers right now are in a situation in which they are not able to spend more. Okay, there's a question here which I'll grab. Tanvi, again, what does the control group measure? It is like all the other headline numbers where we take out certain components and then try to see if you can get a better reading of the underlying. Here, if the retail sales does not take into consideration the cigarettes being sold at 7-Eleven, for example, it does not consider petrol kiosk sales, for example, for people going to the petrol kiosk or top up petrol, for example, those are not included inside the retail sales. So when they take out all these sectors here, it shows that retail sales is better. So they're just trying to see if they can get a clearer picture on the overall health of retail spending. Okay, so go and Google retail sales control group. You should be able to get a better understanding of what this index here is trying to measure. It's basically trying to take away certain volatile component to see if you can see a clearer picture. Okay. There's another question here. Let me get this other question. Stan is asking, why does retail sales, why some retail sales are in negative? What does this mean? What do you mean? Oh, okay. Because this is measured on a month-over-month basis. Okay, month-over-month compared to the previous month, it was negative. Okay, so it it can go negative because there's no growth. Okay, meaning, for example, in October compared to the September number, which was very, very good at 1.2%, October saw a basically no growth compared to this number here. So it was actually worse off. So it was a negative number because this is measured month over month. Okay, when you compare one period to another period, if the current period has no growth, of course it will be on the lower end, and if it's worse than the previous month by a significant amount, it will go negative. Okay, it is not unusual for retail sales to go negative. You can see the whole of last year there were at least 4 instances in which retail sales month over month has gone into negative territory. Okay, so this is not unusual. I hope that has answered your question, Stan. Now, when we look into China GDP, China have a very good GDP numbers. Q4 came in very strong. China actually struggled in Q2 of this year, Q2 of 2024, and then it ended the year very, very strong. Of course, there will be subject to revision, but the first flash estimates for Q4 GDP in last year was 1.6%, which is very, very good. When we take into the whole year consideration, China has been trying to aim for 5.5 GDP on year over year. 5.4% is as good as it comes because in the previous 2 quarters, we can see that it was below 5%. So they ended the year on a very strong note. Okay, I think maybe it has a lot to do with the pushing up of export, or basically you see with the market already knew Trump is going to come in to be the next president, and his tariff policy has actually been the incentive to actually hasten the meeting of export orders. So there's going to be a lot of Americans importer trying to beat the new tariff in 2025 by urging Chinese exporter to ramp up production, so that if those imports can be sent to the United States before Trump's inauguration, then basically those will not be subject to tariff. Okay, but so I think this number here has maybe has some element of people, American importer rushing the Chinese manufacturer to ramp up production to actually try to basically bypass the tariff before Trump's return. Okay, so this could be one of the reasons why we see such a strong Q4 for China. Okay, whether this will be able to sustain, we will have to see in Q1. Okay, again, I think Q1 we will probably see a dip. Okay, because this could be one of the reasons why you can see such a strong growth in Q4. So we also see industrial production, and this is also very much in line with the GDP numbers. We saw a very strong recovery in industrial production for China in the last month of 2024. Massive move up to 6.2%. You can see that the the better part of the last 7 months before December, we can see the market has been doing about maybe just 5 plus and minus 5%. Okay, but you can see the December saw a number above 6%. So this could be what I just talked about, hastening of production by US importer to beat the tariff. Retail sales has also bounced up a little bit. Now, this is more internal, domestic. You can see that compared to November, Chinese consumers are basically ramping up consumption. Okay, so this could be a good sign if they can maintain this momentum into, let's say, the next few months. Ideally above 5%, that means that there is scope for China to actually maintain the momentum in terms of internal circulation. Okay, so going into the Lunar New Year, there is the possibility that Chinese consumer will be outspending, whether they are buying more things for the New Year or they are basically getting more goods for the Chinese New Year, or whether they are going to go out and dine out. That could be something to watch. But there are some videos that I saw online, which saw that this year a lot of stores are not doing particularly well come to, let's say, for example, the buying of New Year goods. In Singapore, we can see that, of course, we have a special situation here. It has been raining very, very hard for the whole of January so far. And that means people don't go to Chinatown to buy New Year goods, for example. That could be something that we also may be seeing in mainland China. But the weather is going to be playing a huge part, whereby whether the retail sales can remain strong going into the next few months. But it's a good sign. Okay, December shows retail sales is coming back to 3.7%. Now, going forward into the coming week itself, of course, tomorrow the market will be closed. There is not only Trump's inauguration, we have the Martin Luther King Jr. birthday, and market will be closed tomorrow. So the firework may begin on 21st. Okay, so 21st, when the market reopens in America, do watch out for firework, because that will be the first full official day after Trump's return to the White House. And from there, we should be able to gauge whether the sentiment is going to be good or bad. By and large, I think it all depends on what Trump roll out. Okay, if he really imposed 25% tariff on both Canada and Mexico, that will basically mean that his tariff policy is going to be damaging, not only to the American economy, but will be very damaging to the world economy. So we will have to watch this. But I think we are beginning to see signs that maybe the tariff that he's going to impose on China may not be as punitive as 60%. Okay, so if that is not going to be the case, then I think the market will interpret it as maybe it's all rhetorics, and maybe Trump is using all these threat as a negotiating tactics, okay, which is not uncharacteristic of Trump. Trump is a businessman. You know, in his book, The Art of the Deal, he always will throw a curveball and then negotiate from the position of strength, okay? So all this threat that he said he's going to do may be a red herring. Basically, he's part of his negotiation tactics, okay? So we have to watch. On Tuesday, we have labor number coming in from the UK. Claimant count expected to bump up from 0.3, mainly 300 jobs. 300 bricks will be asking for help in the month of November to 10,000. Okay, 10,300 people will be asking for help as they are not able to find employment. Employment change, there's no estimate. Previous number was actually 173,000 people newly employed. Okay, as far as the unemployment rate is concerned, they expect it to bump a little bit higher from 4.3% in November to 4.4% in December. Okay, then in Canada, we have consumer prices. We have the core Bank of Canada core consumer prices. No estimate here previously. Month over month, it was 1.6%. Now, this is the regular CPI numbers. Again, year over year, they expect to see a higher number from the Bank of Canada's estimates. 1.7 is what they expect. Now, this is slightly better than the November number of 1.9%. New Zealand will be also looking at the release of the CPI numbers quarter on quarter. They expect it from 0.6 to 0.4. year over year, they expect it to go down marginally from 2.2 to 2.1. Okay. Now, Australia and New Zealand measures CPI numbers on a quarterly basis. This is not ideal because it is very, very lagging. Okay. So on Friday, which is the last day of this coming week itself, we have a major decision by the Bank of Japan. I am market expecting Bank of Japan to actually increase rates by 25 basis points from 0.25 currently to 0.5, and look out for the dollar versus the yen rate. Dollar yen is expected to come back down, okay? Because if the yen is enjoying higher interest rates, like I said, do watch out for this. If the market decides that the Bank of Japan is going to start their rate tightening cycle, it may actually cause the entire yen carry trade to unwind. So we all knew what happened last year when the Bank of Japan is looking to high interest rates, okay? And that has been one of the reasons why the Nikkei 225 actually fell quite dramatically. So whether this will lead to another sell-off in the Japanese markets remains to be seen. But I think if it leads to an unwinding of the yen carry trade, I think that will be a logical conclusion. In Germany, we're expecting the PMI, which is Manufacturing Purchasing Managers Index for the month of January, to ease off from 42.5 to 42. Now, this is again a depression number, okay? Let me just say that manufacturing is still contracting, which is no difference from what we saw in 2023, 2024. Okay, so this is basically an extension of the misery Germany is going through as far as manufacturing is concerned. The Eurozone is also going to be impacted negatively. Currently, it's at 51.6, still in expansion mode, okay, but expected to gradually go down. 51 is not a very strong number, so it's very easy to go back below 50, and if the 50 is the dividing line, right? So in a services sector, this is positive, but manufacturing is still down, okay? Although they do expect a marginal improvement from 45.1 to 45.3. Then we have UK services PMI expected to dip even further from 51.1 in December to 50.6 this month. Okay, so again, this is a negative connotation. And then we follow up by the UK PMI, both for manufacturing and the services sector. No estimates for now, but we can see manufacturing is in the borderline case, just below the 50 mark. Okay, if they can pop it up above 50, that will be a positive sign. But if it goes down below 49.4, it will be seen to be negative. Services has been very, very strong at 56.8. So this is not going to be a deciding factor unless we see a very serious markdown in this number. Okay, 56.8 meaning the US market is supported by the services sector. So far, Biden has failed to reshore the manufacturing sector. So I don't think Trump will do any better. Okay, because his high tariff policy mean to say that there is really no much incentive to set up shops or to reshore into America because the cost of production is high and it do not necessarily have the right workers. Okay, so again, we have to watch how this thing is going to unfold. Okay, let's go into the chart itself. Let me share with you the chart. If you have any questions, do put them into the chat box. I will start off with the Dow Jones. Again, I want to show you what's happening this past week. So we have a bit of a rebound this week itself, very, very strong, which resulted in the closing above the last 4 weeks closing, which is very, very strong. This is an outside bar. This is a bullish engulfing bar. But by and large, when we look at the chart on the weekly time frame, this is possibly the first leg of this correction. This bounce here, unless it can convincingly close above 45,078 in a cash market, I suspect that this is going to be part of a three-way pullback. Okay, I suspect that the first 3 months of this year is basically all about correction. Okay, so it's also one of the reasons why I think this pullback is going to be a godsend for those who missed the bull market. So in the meantime, a corrective pullback is actually what I'm looking at. Okay, do not try to sell this market because the overall sentiment is that this is a very bullish market. You can see that this market here is so bullish, very bullish. Okay, all the way from the pandemic low of 18,219. So the market here is very bullish. This is part of a corrective, and this is the counter trend. Unless the markets, if you are going to be trading counter trend, do so in selective areas. What I mean by that, the area in which you can consider to do counter trend is at a 44,400 level onwards, all the way to 45,000. Okay, if the market goes into this bracket of prices where I've shaded with a deeper pink, this will be a good level to do counter trend trade, putting your stop marginally above the all-time high. Okay, so if this is the case, soon market may actually provide us with a counter trend trading opportunity. But again, this is only to be attempted for those who have very high risk tolerance. Okay, this is the daily time frame. You can see that the market is doing this, right? So this is the first leg. If it's a simple three-way pullback, that will be easy to play. Okay, wait for the market to exhaust itself, as ideally within this bracket of prices, 44,400 onwards. If the market shows signs that it's going to come back down, if they within this area, okay, this is of course the daily time frame. If within this area of 44,400 all the way to 45,000 onwards, we can see that if the market show a reversal signal within this bracket of prices, that could be a sign that the market has lost its momentum and may be completing its three-way pullback. Depending on how deep this rally can be, okay, the higher you go, the shallower the correction. But if the market starts to lose momentum and start to come off, do look out on a day-to-day basis for the sign. Okay, there's a new question here. Let me see what is that. Tandy is asking a new question. He said, would we expect retreat of the US market and the yen increase over the dollar when Japan increased? Yeah, okay. When you look at the individual markets, for the time being, let's not consider the impact of the yen rate hike, okay? Because the US market is moving on its own steam, okay? Because this market here is rallying in expectation of Trump's return. Okay, of course, the CPI numbers and PPI numbers that we saw this past week has been excused if you read the traditional media. Okay, but this rally here is basically to confirm. Basically, it's a Trump rally. Now, remember back in November when Trump won the election, the market took off. Okay, and this could be the rally before his return. Okay, so again, once he come back, watch out on Tuesday, because I think something big is going to happen on Tuesday when they move into the White House. Okay, again, we will all be waiting eagerly for his policies, especially the trade policies, whether he's going to impose what kind of tariff, and yeah, we're going to basically be taking cue from Trump. Okay, he said he's going to sign 100 executive order on the first day. So it is basically trying to bypass Congress. Congress is supposed to be the check and balance, but if the president can actually sign into law by bypassing approval from Congress with his executive orders, I think Trump has basically started a trend whereby he has excessively used his privilege to impose new laws through executive orders. Okay, so I think that will be a characteristic of Trump's administration. We saw that in the first term of Trump's administration back in 2016 to 2018. You can see that he has been signing a lot of executive orders. So this is, like I say, a expectation of Trump's return. Okay, once he returns, look out for the reaction. I think Tuesday night will be very, very telling. If on Tuesday night the market closed negatively, that means this rally is over. Okay, but based on the weekly time frame in the Dow, it suggests that they possibly could have legs. Okay, so just take this into consideration when you're looking at the US equity markets for the Dow. Okay, when we look at the S&P 500, again, let's start with the weekly. Now the weekly also do not have an outside bar, but it closed very strong. Now this closing here is the highest we have seen over the last 5 weeks. Okay, so that is a good sign. And the pullback here is not as clear as in the Dow Jones. Okay, so there is a good strong case for the S&P 500 to actually challenge the all-time high at 16,100. Okay, this could be one of the strongest equity index right now. When we consider the daily time frame, let's look at the daily time frame. Sorry, this pullback here has already unfolded as a three wave. Now, if you look at this from this perspective, using the simple pullback. Let me change this to 1. Then we can see the market did not quite get to the equator, got to the equality level, but we have a very clean 3-wave. Okay, and this is followed by a pin bar, and the market now is rallying. Again, we will have to see how the market behaves within this bracket of prices on the daily time frame. That level is from 6,030 all the way to 6,100. If the market struggle within this bracket of prices, which is highlighted by the shaded pink color, then obviously that could be a case whereby the market is unable to follow through. Okay, but when you look at the structure so far, it does appear that the S&P 500 is very bullish, or could, if the market actually want to resume its bull market, I think it may actually come from the S&P 500 first. Okay. Now let's take a look at the Nasdaq 100. This is the Nasdaq 100. You can see that again, when we look at the weekly, very, very strong. Okay. Again, very similar. We do not have a classical reversal pattern, but the closing here is the highest for the last 3 weeks. Okay, it doesn't have a strong closing compared to, let's say, the S&P 500, but it is nonetheless a pullback from its lowest level. In the weekly time frame, you cannot see a clean 3-wave, but in the lower time frame, you can see one. Okay, there's another question here which I'll grab again. Wayron is asking, do I foresee a bull trap in US equity markets given the price action and the macro news? Actually, what I am thinking is that the market is building up to trap the bear. Okay, not so much as a bull trap. I think it's likely to be a bear trap. Like I said, over the next 2 months leading to the first quarter of this year in March, I think the market is expecting the market will pull back. Okay, and if the market does pull back, okay, so long it doesn't result in a waterfall steep collapse, okay, I think sellers will be looking for opportunity to trade the counter trend, and if they do, I won't be surprised those people who try to sell will be trapped. Okay, because I think after this pullback, the market is going to rally to all-time high again. Okay, I do not know what will be the catalyst, but I think the market here sentiment suggests that this bull market is not over yet. Okay, we may see new high, at least in perhaps after Q1. Okay, so this could be building up to be a bear trap rather than a bull trap. Okay, so let's look at the daily. Sorry, the daily. Yeah, here. So the daily here, we can see a very neat 3-wave. You can see this 3-wave here. Okay, also a very neat 3-wave. It did not quite hit the ideal point, so which gives rise to the idea that this could be a more complex pattern than most. Let me see where the market is. Okay. Here. It did not quite hit equality here. Equality is about 20,400. So the market have a low here. We will end up with a reversal pattern at 20,527.5. Okay, you can see this on Monday itself. Tuesday, the PPI number was released. Wednesday, the CPI number was released. So the market took the cue from both the PPI and the CPI numbers. So again, the market, we will have to watch how it performs within this bracket of prices, starting from 21,800 all the way to 22,130. So if it struggles here, we could end up with a more complex corrective pattern. But by and large, I think the market is already in that phase whereby market participants are getting very itchy and trying to trade the counter trend. Okay, this is my expectation. So when we move out of US, when we look into, there are a couple of questions. Let me address them first. We're then asking, okay, Jim is asking, do I think the yield curve inversion will not lead to a recession this time? Like I say, there is that throughout history, whenever we have an uninversion, not the inversion itself, for the whole of 2024, we saw how the market inverted in terms of the yield, okay, whereby the short-term yield is it's higher than the long-term yield. Okay, now we have market going back to normal, what we call an uninversion, and it's the uninversion that's going to do a lot of damage. But there is a lag time. Okay, anywhere between 4 months to 12 months is where the recession may actually happen. It will not happen immediately, but the fact that the markets are uninverted in the yield curve market eventually will, so far throughout history, has never failed to produce a recession. So as we move into the later half of this year, okay, perhaps Q3, Q4, for example, that is where we possibly will see a recession because there is a lag time. Okay, the uninversion only happens in December of last year, so we are only 1 month into the uninversion. Like I say, it could be anywhere between 4 months to 12 months before the recession actually materialize. So yes, based on history, a recession is going to be the expectation, but whether it's going to happen in Q1, Q2, nobody knows. But I think the momentum in the US market may actually may actually carry forward. A lot will depend on the damage done by the Trump's tariff policy. Okay, if that result in slower economic growth around the world, then eventually it will hit the US markets. So yes, going into Q3, Q4, there's a very high likelihood a recession is going to be the end result. Okay. Hopefully, Jim, that is an answer for you. Now, when we look across the Atlantic, we look at, for example, the FTSE 100. The FTSE is at all-time high. Now, this is the monthly time frame. You can see that it's an all-time high, right? This happens on Friday when the market actually gone. And the way I look at it is this: it could be a currency play, okay? Because the pound sterling and the euro has actually fallen quite a fair bit against the dollar. So if I'm a US fund manager, when I look across the Atlantic and look at the prices, equity prices in the States and equity prices in Europe, European equity markets appear to be cheaper. Okay, so that could actually result in people going in for the value play. Okay, in relative markets. So do not buy this index higher just yet, because if the correction in on Wall Street is not over, it's very difficult to sustain this rally. Okay, yes, technically you look at it, it is very, very strong, but the monthly chart is not conclusive yet because we are only in the middle of January. We still have 2 more weeks to go before the month end. So this monthly chart is not very conclusive just yet. You look at the daily, weekly, for example. Okay, this is the weekly time frame. Very strong. Okay, the market has gone sideways for a long time, especially after market hit a low of just under 8,000 and end up with a pin bar like this. This typically should actually result in a very strong recovery, but this recovery comes this low was actually traded in April of last year. So for the last 8 months or so, you can see the market has been struggling until recently, until this week. Okay, like I say, this could be a currency play, not so much a testament of the strength of the UK equity markets. Okay, UK is in a lot of hurt. Okay, so there is no reason why should be buying the European equity markets. But if you're a technical trader, look at this, it does looks very, very strong. Okay, when you look at the daily, for example, daily has been so strong, right? So this play is no longer valid. I was expecting a continuation of the pullback. So now we don't see that happen. The market is at an all-time high. So we will see whether it can sustain. The month, how it closed at the end of January will be very telling. Okay. So far, I'm not buying this. Okay. For those who are into short-term trading, maybe you can continue to buy the dip if there's going to be one. Okay. And in the German market is also at all-time high. Where's my monthly? Okay, this is so strong. Okay, when I reduce it, you can see that the market has been so strong from the 2008 global financial crisis. The low was there, and the market has resumed its uprun. Okay, so based on this chart, it's very difficult not to say the market is a buy. Okay, but I have no confidence to buy these markets purely because the fundamentals are all wrong. Okay, technically it looks like a buy, but fundamentally it's telling me, it just doesn't feel right. Okay, and then in the weekly time frame, this is the weekly time frame, very, very strong closing. If you're a technical trader, you should be buying this. Okay, but I'm not convinced. Okay, so I'm not looking to do anything in the European market. If anything, I'm looking for a loss of momentum here. So you take a three-way from the low here that we saw in 2020, which is the pandemic low, 100% is already hit. So the market has really hit its equality level. It's very dangerous right now. If I add in one more level, okay, anywhere between where the market is right now and this new level at 123.6% extension, it will bring us to somewhere like this, okay? 22,140. That's about all, okay? Right now we are at just under 20,900. Upside, not much of potential. Moreover, the market is already outside my green color box, which is not where I want to be buying. So when you look at it this way, I will just watch, okay, waiting for the markets to actually show signs of weakness. Over in Asia, we look at the Nikkei 225. We look at the weekly. Now, because of the expectation of rate hikes, we can see that the market is becoming very cautious. The market has not been able to sustain above 40,000 in any meaningful way. For the last 3 weeks, we can see that the Nikkei has actually been struggling. So that could be setting the stage until the rate hikes actually materialize. So this week, I think all eyes will be on the BOJ rate hikes, and we want to see how the Nikkei will perform based on what we saw last time. Okay, from here, we can see that the market actually go down all the way quite dramatically from 42,500 all the way to 38,400. So that was a loss of what 5,000 points. Okay, and this is of course the what you call it, the yen carry trade play. So if this result in expectation of unwinding of yen carry trade, we can reasonably expect possibly the same reaction that we saw here. Okay, so watch out for the Nikkei 225. This week will be, I think, the key market to watch. There's another question here that just popped up. Okay, thank you very much, Jim. So Nikkei 225, watch out for reaction. Right now, the market has been undecided which way to go. Okay, it wants to go higher, but I think it's meeting very fierce resistance at the 40,000 levels. So unless the market can close above this level very comfortably and ideally above 42,519, the market is under a lot of pressure to trade off. Okay, so from this higher perspective, I do expect a lot of pressure on the Nikkei 225 here. Okay, you can see that market is struggling. So you can see there's a very simple support here. Market hit the support and we respected this level. So we have to watch if the market can close below this this imaginary support line here. This is based on the daily time frame. Okay, basically I'm bearish on the Nikkei 225. Although the market is still positive as far as the buyers is concerned. Now when you look at Hong Kong has been under a lot of pressure. Okay, despite the strong GDP numbers for China in Q4, we can see that the Hong Kong market actually has been struggling. Okay, it has been struggling because it has finished a three-wave equality move from the low here to the high to the low to the high, exactly marginally above the equality level 22,885. Okay, so the market has not been able to go back up. Okay, so this is not a very strong reaction here. This is based on the weekly time frame. Although it has a strong closing relative to the week before, but it is still very, very tentative. Okay, based on China's Q4 result, it should actually result in higher prices in the Hang Seng. But I think the market is still waiting for. I think it's a waiting game. China is waiting for Trump's next move before they decide how much to stimulate the economy or how much stimulation they need to roll out. So I think at the end of the day, everybody's waiting for some kind of China rolling out the bazookas, okay, to stimulate the local economy. It all depends on how Trump reacts. If the tariff that Trump want to impose on China is very punitive, then the Chinese will have no choice but to take out very serious stimulus package, and that could actually cause the market to rally. But in the meantime, I think the market is in a wait and see mode. Okay, the ball is in Trump's court. It all depends on what Trump's do in the first week of his administration. Okay, so this coming week is going to be very crucial. So when we look at the daily time frame, it's also showing us the same thing. Okay, there has been tentative buying, but it's not strong. Okay, so this two line here represent the immediate bottleneck. The market must close above this line, which is currently by and large above 21,300. Okay, the highest closest we have here is this particular bar here at 21,302. Okay, market must close above this because so far this line here at 21,300 has been the limiting factor. Okay, so if this market has any hope of recovering, it must close above this line. Okay, so this 21,300 is going to be very, very crucial. Watch out for this line here. And then when we look at the other markets other than equity markets, okay, let me see. Let's go into the currency markets. On the weekly time frame, you can see that the current weekly time frame, you can see that I basically survived that stop. I told you I'm actually caught on the wrong side of this market here, and the rebound which I was expecting did not materialize. So far I still survived the stop, but there is, I think, a matter of time before my stop is taken out. Hopefully, the market can recover a little bit better for me to exit with a minimum loss here. So, but by and large, you can see the euro has actually collapsed. When you look at the euro from a higher perspective, from the monthly time frame, this is a very scary chart. Okay, the euro has been falling and falling for year after year, from 1.6 against the dollar to as low as below parity at 95 cents. So this 95 cents, I think, will be revisited, at some point in time. Over the longer period of time, I think it will not be an impossibility for the euro to go to 50 cents. Like I said, historically speaking, this currency is likely to go extinct. Okay, so the sentiment has been very, very bearish. So ideally, if we get a bounce, okay, which is still possible at this point in time, over the longer period of time, we should be trading on the short side of this market. Okay, I have learned my lesson. Do not try to pick the bottom here, because I was expecting a three-wave bounce. Okay, and it apparently it is not happening right now for me. So if the market ever bounce back, and the market start to lose momentum, trade from the short side of this market. I think the long-term perspective is the euro. In fact, all other currencies relative to the dollar is going to be weakened. That means all currencies, whether it is the Chinese yuan or whether it is the ringgit or whether it's the Sing dollars, I think relatively speaking, all currency when compared to the dollar is going to be weak. Now, the Donald Trump actually won. I think Donald Trump is conflicted. Okay, generally speaking, he wants a strong currency, but he also needs a weak dollar to be able to sell more to the rest of the world. Okay, but if the global economy is slowing down, perhaps as a result of his tariff policy, then there will be very little demand for American products. Okay, so a weaker dollar may not actually help to for Donald Trump to sell more to the rest of the world. Okay, but if the dollar currently is strong because of expectation of less rate cut in 2025, okay, then that will make all the other currency relative to the dollar weaker. Okay, so I think the strong dollar is going to be what we are seeing right now, not so much as a testament of the strength of the US economy, but it is understandable because when you compare the G7, among the G7, the US economy is the strongest, if you believe the GDP numbers to be accurate. So far, we can only base on what that has been released, which clearly show that US economy is very, very strong. Okay, and that will logically means the dollar will remain strong, at least for now. Okay. Now we will have to watch again. Nothing is cast in stone, but the euro is by and large actually a long-term bear market. This is the daily time frame. On Monday, we have a pin bar here. Okay, so this pin bar that we saw on Monday may be actually maybe causing the market to actually rebound a little bit. Okay, so how far the market can rebound? I think the market, realistically speaking, is going to be kept around here. Okay, 1.04. 1.0440, because they see that there is a lot of resistance around this line here. Okay, so if there's going to be a bounce, I think the best I can expect is going to be somewhere about 1.0440. Okay, then again we will have to watch. Right, there is also synonymous with the other currency. When we look at the sterling, sterling is also on a long-term downtrend, 2.11 all the way down to 1.03. And I think for the sterling to go to parity, it is not impossible. Okay, over time, I think the sterling is going to continue to drop. Okay, so watch out for this. Here, see here I see there's a panic cycle coming up this month. So this could only be a negative for the sterling. On the weekly time frame, market is already as low as it gets compared to 2 years ago. In September of 2023, there was a low. Now the market is revisiting those lows in September of 2023. So there is the possibility the market will continue to weaken all the way below 1.18. Okay, so if the market close below, or don't say close, dip below 1.18, I think the bear market has resumed in full force. After that, any kind of bounce is going to be an invitation to sell. Okay. In the daily time frame, I think it's quite clear cut. This is a bear market. Okay, very strong. Market top out at 1.3430, and it has been falling since. So I think it's quite negative. Now, when we look at the dollar versus the yen, now in the monthly time frame, this is a very bull market. Okay, the dollar is very strong. Okay, the Japanese cannot allow the yen to continue to weaken. Okay, the last time they intervened in 162 against the dollar. So the market now high this week so far is at 158.90 thereabout, and it is beginning to hit a ceiling. Okay, because this is the bracket where the market is likely to hit a pocket. From 157.16 all the way to 162 is going to be where we want to watch whether it can punch beyond. Okay, but for now, because of the expectation of BOJ rate hikes this coming week, the market will have less incentive to punch through. I think more likely it will go down. Okay, but it is a pullback within a very long-term bull market. This is also testament to the strength of the dollar. Okay, you will see that when you compare the dollar against all the other currency, the dollar is definitely very strong. Okay, so this is the weekly time frame. Market struggle, okay, but I think the market has stopped going up. High is 158, almost 90. This entire week, the market has been struggling. On the lower time frame, again here in the daily, you can see that the market has come off from mid on Wednesday, Thursday, and Friday. Friday, we see a bit of a bounce, but I think the market is getting ready to sell off, okay, in expectation of rate hikes. When we look at the dollar strength from the dollar Canadian, is also very clear cut. Dollar Canadian is so strong, right? The way it closed, this is the highest closing since when? Since the global financial crisis. In terms of on a close-to-close basis, this is the strongest because all the other markets here, the previous times, the market actually went beyond, but it never closed anywhere above 1.41. Okay, so this is the strongest closing we have seen so far, and the month is not even out yet. So on the weekly time frame, you can see weekly has a very strong closing. Okay, very strong closing. So this is the same thing that we saw across all currency pair. If you measure against the dollar, all currencies are weak. What about the Aussie? The Aussie is also in the doldrum. Monthly time frame, I think there's a very good chance that the Aussie currency is going to go below 55 cents. Is this the lowest you have seen? And this is about the lowest you have seen throughout history, 55 cents. Can it go below here? You don't say cannot, okay? Nothing is impossible. I think based on the numbers that we've been seeing for Australia, the Australian economy is definitely struggling. So a weaker currency is to be expected, okay? Unless China roll out a stimulus package, they will result in more Chinese import of Australian minerals. That will be a positive for the Aussie dollars. But until that happens, no, okay? But we can see Australia has been trying to mend the fan with China. So I think that will help, okay? if there's less reason for Chinese not to buy from Australia, that would be seen to be positive. Now let's get a look at the Kiwi market. The Kiwi is also very weak, okay? On a close-to-close basis, this is as weak as it ever closed, okay? This is the weakest since 2008 in terms of closing. So the Kiwi market is also negative. So when you look at all the other currency pairs, when compared to the dollar, all the other currencies are all weak. So the dollar strength is very, very evident. Okay, do not try to sell the dollar. I think we should be trading on the long side of the dollar compared to the other currencies pair. It's the question of which currency to sell against the dollar. Okay, but I think dollar strength is so evident here. Okay, right. This is the weekly time frame, also negative. If the market breaks below this 55 cents, we could eliminate this box here and keeping only the pink color box. It means the technically outlook is in favor of further losses. What about the daily? The daily is also very weak. Okay, this is a very tentative counter trend bounce, but I think it's losing momentum. Okay, so I have painted a picture of dollar strength against all currencies. Let's take a look at the precious metal market. Now, precious metal market is not doing well for now, okay? Yes, I think there's a bit of strength of late, okay? But I think this pattern is not over yet. Generally speaking, I think the gold market is doing a corrective pattern. We have the first leg down all the way to $2,336 per ounce in the gold market, but I think it's still tentative. Unless the market can close above $2,790 per ounce, it's likely to resume its counter trend move. But by and large, this is a very, very strong market. Okay, you should be looking to buy. Okay, my wife told me that my holdings of gold has actually doubled since the last time I checked. Okay, so she asked me whether I can sell. I said no, don't sell, because gold is going to go a lot higher. Okay, because the coming sovereign debt crisis is going to cause a major collapse in equity markets, and I think that would be beneficial to gold, to precious metals. Okay, so we can see that the weekly time frame, the market likely to hold within this area here because there is that range trading before the market rally, right? So I think if there's going to be a pullback, there's a very good chance we can see a three wave. So this week, although the market has closed higher, but there is no momentum behind this move here. Over time, I suspect that this thing is going to see a pullback, especially if the dollar become very, very strong. I think there's a incentive for the gold market to actually pull back. If we see a pullback below the $22,536 per ounce, I think somewhere in this area here, there could be a bottom. Anywhere between $2,470 to $2,531. I think that could be a bottom in place. Okay, so watch out for that. Daily time frame, I think it's the same. Right? So daily time frame, you can see the market is struggling. Markets are expecting this most recent high here. This on Thursday with the high is 2,724 and 70 cents, marginally below this high here that we saw back in December of 12th of December last year. So again, I do not believe the market is getting ready to rally. It could be a case where market will do a complex three-wave pullback and settle somewhere around the $2,430. Okay, basically it's at the edge of this green box here. It will be a natural support level. So for those who have not got into the gold trade, I think this pullback is going to be the last time you're going to see prices at these levels. So in the silver market, I think silver has been underperforming. Okay, it has done a three wave. It has not hit its ideal target at $36 per ounce, but over the last few months, we can see that it has been struggling. This high that we saw at $34.85 was actually traded in October last year. So for now, for 3 months in a row, we can see that there has been an attempt to rally. Okay, but the month is not over yet. So we still have 2 more weeks to go before the end of January. So this is not conclusive. A better area to watch will be the weekly time frame. Now really is also very, very, very tentative. Okay, we can see this likely three-wave pullback. possibly targeting anywhere between this range. Okay, that means this bar here is going to be very it's going to be very pivotal. $26 to $27.42. If the market can go into this bracket of prices, it will actually be a pocket of prices in which I think may be able to hold silver prices before it resume its long-term climb. Okay, so silver is also relatively strong. Okay, this pullback is nothing more than a technical pullback. I'll show you the daily. The daily is also struggling, right? So I think there's a good chance the market will continue to come back down again. Okay, three wave should actually target $27 to as low as $26 per ounce. Basically, this area here, anywhere between these areas. These two leg, the bottom here will be crucial. If you extend it all the way to the right, this could be what we are looking at. This area will be very interesting to watch, whether the market can hold at this bracket. If the market do pull back into this bracket of prices, okay, we will look for reversal pattern within this bracket, if it does. So right now, just observe. Do not try to sell this because the market is not a bear market. Okay, trade with the trend. The trend is basically very bullish. What about oil market? Oil has been going higher. Of course, we knew at the end of last year, Ukraine has actually not allowed Russian natural gas to go through Ukraine to be exported into Europe. At the same time, okay, Russia has claimed that there is another pipeline from Russia all the way to Turkey, what you call the Turk Stream pipeline. Okay, Ukraine has actually attempted to bomb it. Okay, it is still operating, and that has already caused sentiment to be bullish on the market. And right now, if the European will have no choice to buy Russian gas, then they will have no choice but to buy liquefied natural gas from America. That would actually put a floor underneath the energy markets. So we can see crude oil prices based on the WTI has actually stabilized at about $65 per barrel. Now it's trading above $77 per barrel. Okay, so this could be setting the stage for a very big U-turn. Okay, so pullback will be seen to be ideal for accumulating positions. So this is basically the weekly time frame. I think the market has already bottomed out, basically. Okay, so if you're looking to do crude oil, wait for market to pull back. Okay, we have a three-wave bounce so far. So if the market cannot sustain and start to go down, that could be a buying opportunity, but you got to catch it on the lower time frame. A couple of more questions here. Let me see. Bak Song Lim Bak Song. Okay, dollar versus Swiss franc. Okay, I will do that. Do I have target price? Do I have target price? If you sell your gold and you're holding, I'm not looking to sell. I don't have. I just given you the level to look out for gold prices. Hopefully, let me revisit the gold prices. Okay. Like I say, I think there's a possibility gold prices may hit certain levels. Let me see, where's that on my weekly? This area. Anywhere between $2,470 to $2,531 per ounce. This bracket, if the market result in a three-way pullback, this will be a natural pocket to support the prices. So if the market do pullback, okay, hopefully by March this year, because March is going to be crucial for me, because I see all markets starting to correct. Okay, whether it's equity markets, whether it is currency markets, and whether it is precious metal market. I think they all points to somewhere in March. Okay, so if this may result in a pullback all the way into this bracket, by then I'm looking for a reversal signal here to confirm. Then before we go back into trade with the trend is up. Okay, so for those who are looking for dollar Swiss, I don't trade dollar Swiss very actively, but again, just to give you an idea, the dollar Swiss is this rebound from 70 cents does not look over yet. Okay, so there's a possibility we can do something, re-challenge the 1.03 levels over time. So for 4 or 5 months in a row, we can see that the dollar has been recovering. And this is no accident. And the market started to stabilize in September of last year. And that was also the first time the Federal Reserve cut interest rates, September 18. And this is what we are seeing. Ever since the Fed cut interest rates, the dollar has actually rebounded instead of falling down. Okay, when the Fed cut interest rate, you will logically expect the dollar to be weakened, but we have not been seeing that for the last 3 months or 4 months. Okay, since the Fed pivoted, the dollar has been very, very strong. So, like I say, it is very evident across all time frame, across multiple currency pairs. This is the weekly time frame, double bottom here, and the market is going up. So now the market has to convincingly trade above this level. Okay, on a close to close level, I think that it has already closed above this level marginally last week. Okay, so we can see on a close to close basis, don't look at the high and the low, look at the close on close basis. Maybe it would be better if I show you the line chart. Oh, let me change the color. You can see on a close to close basis, 1 pick, 2 pick, 3 picks. Now the market is about there, So it is very important that it managed to continue to close higher. Okay, if it cannot close above these levels, I think there will be pressure for it to come back down again. Okay, so again, do not always look at a candlestick. Sometimes you could look at a close to close basis. So for now, if I have a choice, I will be buying dollar Swiss because it's hitting against a ceiling. I need the market to go and close above that invincible ceiling. Once that is done, any kind of pullback is a buy. Right. I think over the last few days, especially yesterday, the market seems to be focusing on cryptocurrencies. Bitcoin, you can look at the Bitcoin prices. It is very, very strong. Okay. The market may continue to go higher towards 125, and then we probably will see a pullback. Okay. So we will have to watch higher prices. It is very seductive to buy on breakout, but don't buy the breakout. Okay. Buy on pullback because this market is so strong. I think this year will be another very positive years for crypto. Okay, because never happened before, where we have the U.S. administration, the people running the administration in the U.S. they are very crypto friendly. Okay, so this will actually put a positive spin on this space here. So I think this year will be a very positive year for cryptos. The question here is which coin is going to be the one to watch. Okay, I think there's a couple of winners already so far. Okay, Bitcoin, I think it will continue to go higher. It's a target of 125,000. Okay, but I think suspect a pullback. Okay, if the market pulls back, it's going to extend all the way to 2029. So long term, this market is so bullish. When we look at the lower time frame, for example, we look at the weekly, the market is poised to go. This is the highest closing throughout the history of Bitcoin. Close on close, okay, this is the highest it ever been. Currently trading at about 105,000. The high traded is $108,845 per ounce, per coin. But I think on the close to close basis, if the market close around here, the market is still active, okay, then of course, this will be the highest it ever closed. So this is a very positive outcome, okay, but be very careful trading the breakout. Now, the other markets which I am very positive about is actually Ripple, okay. I have been talking about Ripple for a long time, for quite some time now, not a long time, for quite some time. You can see that this is the Ripple market, very young market. You can see this market has actually exploded. Since when? Since September, okay, since October, okay, when Donald Trump won the election. And of course, the news is that the current SEC chairman, okay, Gary Gensler is going to resign on the very same day that Donald Trump is going to be inaugurated. Now, this is the man who has single-handedly kept the rise in Ripple, okay, because he has actually sued Ripple Lab for launching a security without a security license. But Ripple Lab has always contested that the SEC has never fully defined what is security, what is commodities. So the last case in which the suit between the SEC and Ripple Lab has resulted in the judge ruling in favor of Ripple Lab. So over the last few days, we can see that the SEC has actually appealed that judgment, okay? But because the current chairman is going out in less than 28 hours time. Okay, the incoming SEC chairman is very crypto friendly. He is in favor of less regulation, and that is can only be positive for Ripple. So Ripple has been quite parabolic. It doesn't have the big drawdown that we saw in Bitcoin. Okay, in fact, it is technically speaking even stronger than what we see in Bitcoin. The pattern, the structures suggest that we are going to see much higher prices in Ripple. So this is a very strong coin here. It has use cases. 85% of Japanese banks use the Ripple blockchain for cross-border settlements. Okay, so we can see that it has use case, and recently it launched the RLUSD, which is a stable coin. At the same time, when the Ripple launched the stable coin, the current dominant stable coin, which is USDT, Tether, has been banned in Europe. So I think the Ripple is going to eat into Tether's market share. So there's going to be a lot more. Okay, because the stable coin market is going to be huge, and Ripple is the only coin, okay, the only token that has been approved by the New York regulators. So with that in mind, Tether do not have that designation. Okay, so Ripple coin has a lot going for it. Okay, currently this week we saw a high traded at $3.40 out of nowhere. Okay, see, the market has been parabolic. So there's going to be a lot more potential in this particular token, purely from the technical outlook itself. Okay, very strong. This is the daily time frame. Now the other coins this week that has actually benefited, okay, is this coin called Solana. Solana is at all-time high this week. So this is the monthly time frame. Nothing much to see here. Let me show you they don't have a lot of history. Okay, the market hit its target. So this is very strong. This week alone, you can see Solana go up to all-time high. And the news that I read is that there is a meme coin called the Trump coin. Okay, nobody can actually say whether Trump invested in this coin, but it is closely related to Trump. Okay, and they use the Solana blockchain, and so it has spillover effect on this coin itself. So on this altcoin, you can see Solana has actually benefited from all this trading about the Trump coin. The Trump coin, if you go back to, it's already listed in Binance. For those who are in this business, go and check out the Trump coin. It went from a few cents to $14 in a matter of days. Okay, so this is very explosive. So currently this week, all attention is on this Trump, so-called Trump coin. Okay, it may be a meme coin. Okay, but again, all this speculation of the return of Donald Trump 2.0 is causing a lot of excitement in the digital market space. Okay, the digital asset space. So okay, I think I've showed you enough of the coins and the market I want to share with you. Any last question you have for me? I will take one last question if you have. If no, then I will have to end the session, and I thank you for your time. I shall see you next Sunday. Okay, we are getting very close to the Lunar New Year, and I will continue to host this. Thank you very much, and I'll see you again. Bye-bye. Tanvi is asking what's the price target for Ripple. Nobody knows because it's trading all-time high right now. Some say it will be in the thousands. I do not know. Okay, because right now it's trading at $3 and you're only trading at what? $3.40. Ripple. $3.40 is the high. So I think it has a lot of potential. Keep an eye on this. All right, thank you very much, and I shall see you next Sunday. Bye-bye.